So in the consolidated statement of financial position, you are going to do that work in there. The figure that you'll be interested in will be the total figures here. But to get to these total figures, you need to do some workings. So under non-current assets, you're going to bring your PPE, which is property, plant and equipment. The property, plant and equipment, you get 100% everything given in the question for the parent, 100% everything given for the subsidiary. Then the fair value adjustment, the one in the goodwill, will come there under adjustments. Now there will be two adjustments figures here under the adjustments. Pay a lot of attention to my explanation on this adjustment here. We did mention that if the carrying amount is higher than the fair value, the difference in the computation of goodwill we're going to subtract. Equally, in this adjustment, we'll subtract that fair value adjustment from these two totals here. So the fair value adjustment there will be a minus. We also mentioned that if this fair value adjustment is any assets other than land, then that asset should be depreciated. If we subtract the fair value adjustment here, then the depreciation we are going to add. To give us our total here. I'll repeat. The fair value adjustment, if we are subtracting it in the goodwill, we'll also subtract it from these totals of the parent and the subsidiary. Then the corresponding depreciation from this fair value adjustment will be added here to give us our total. But if the fair value adjustment was added in the goodwill, that is, if the fair value was higher than the carrying amount, then the difference was going to be added in the goodwill. When we come here, the fair value adjustment will also add it to the PPE, of the parent and the subsidiary. Then the depreciation for this fair value adjustment, we're going to subtract it to give us our total. Any question? So that's how we treat the fair value adjustment in the balance sheet. After the PPE, the next will bring the goodwill calculation. This one, goodwill, will come from the workings. Then whatever other assets are given in the calculation, in the question, will be added there. Then we'll close and get our total non-current assets. Not a very friendly whiteboard, this one. Once we are done with the non-current assets, then we bring in our current assets. Under the non-current assets, we bring in 100% inventory for the parent plus 100% inventory for the subsidiary minus unrealized profits. We discussed unrealized profit. The unrealized profit is the profit for those goods which are still within the group for any intra-company transactions where the parent either sells to the subsidiary or the subsidiary sells to the parent, and those goods are still within the group, they've not been sold outside the group. Or any portion of those goods which are still within the group. The unrealized profit, you are going to subtract it from the inventory. That will be done under the adjustments. The next, under inventory, you bring your receivables. Again, you get 100% receivables. $100 receivables for the parent, 100% receivables for the subsidiary. Under the adjustments, if there are any amounts owing, either the parent is owing the subsidiary for any inventory which was sold to the parent, or the subsidiary is owing the parent any inventory which was sold to the subsidiary, those amounts which are owing should be eliminated here under the adjustments before you get your total receivables. Next, you bring the cash. Again, 100% cash for the parent, 100% cash for the subsidiary. Yes, please.
So for the amount owing, whether it's the parent, we, or it's the subsidiary, we add it?
Come again?
I'm saying whether it's the parent or the subsidiary owing under a receivables, do we add the balance?
No, you subtract.
We subtract.
You subtract, yes. It doesn't matter who is owing who. It's going to be 100% receivables for the parent plus 100% receivables for the subsidiaries minus any amounts owing.
Okay.
Yeah. The same thing under the unrealized profit, to be 100% inventory for the parent plus 100% inventory for the subsidiary minus unrealized profit. Cash, you're going to bring 100% for the parent plus 100% for the subsidiary. The adjustment there will be if there's any cash in transit plus cash in transit. This is where one who is owing has made a payment, but the other one has not received the cash yet. So the cash in transit should be added to the cash. Once we are done with the current assets, we get the total and add that total to the total of the non-current assets to give us total assets. So add the totals for the non-current assets to the total of the current assets to give you total assets. Once you've got your total assets, you move to the equity section. You're going to have a heading equity and liabilities. Under this section, you bring the share capital. The share capital is treated differently from the others. The share capital, you only bring the share capital for the parent only. Take note, the share capital, you only bring in the share capital for the parent only. Then you bring your reserves. The reserves will come from the working. Remember, we have done a consolidated reserves working. That's where the figure will come from the workings. If we have other things like other components of equity, they'll come there. The other components of equity, you only bring in for the parent only. In F7, not so much of other components of equity, quite rare, but you get to meet those in P2. Once you're done with the reserves, then you bring your non-controlling interest. Am I able to copy this? The non-controlling interests again comes from workings. Remember, there were three workings we did: goodwill, reserves, and non-controlling interest. So that's where those workings end up. That concludes the equity section. Then you have another heading, non-current liabilities. The non-current liabilities, again, you get 100% for the parent, 100% for the subsidiary to give you a total. Then you have another heading, current liabilities. Under the current liabilities, you are going to have payables, the payables you get 100% for the parent, 100% for the subsidiary, and then under the adjustment, whatever amount is being owed, the same figure which you subtracted under the receivables will be the same figure you're going to subtract under the payables. Because if the parent sells on credit to the subsidiary, the parent is going to record a receivable to indicate that the subsidiary is owing the parent. The subsidiary, on the other hand, is going to record a payable to show that it is owing the parent. It has to make a payment at some point. So the same figure will come out under receivables and under the payables. Then the last calculation, the last entry will be your taxation. 100% parent, 100% subsidiary. Then you are done. You close, sum up the total equity plus the liabilities, and you're done with the balance sheet. Any question on that calculation, on that consolidation, before we move to the profit and loss?